Now we have Luis Urquijo from La Muza, our first Spanish speaker of today. Oh, no, este no.
Aquí se ve también.
Deberías verlo. No sé por qué no lo ves. Aquí.
Ok, bueno, perfecto, gracias. Well, thank you, Christian, for gathering all of us every year here, and of course for hosting this event and for inviting us to speak in front of such a good crowd. So, a few words on, if I'm able just to make this thing go forward, which I'm not. ¿Dónde tengo que apuntar con esto? ¿Ahí? On who we are, we're just an independent asset manager based in Spain with managing some 350 million euros at this time. We have a very much value-oriented, really long-term proposition in the sense that we tend to stay many years in our companies. Our period of investment, I would say, goes beyond 5 years in each company of our portfolio. Quite a concentrated portfolio, some 30 names, roughly speaking. And our first fund, it's now 27 years old, to be honest. And we've been just compounding around the tens. So this is a little bit of the history of our first fund. And so we do have some sort of 3 types of investments, 3 types of, let's say, value proposition approach. First one is the classic trying to find out companies with some of the parts inefficiencies. And then we do what we call cyclical value. We invest in companies that have a different business cycles, and we try to buy those cycles when they're bad moments, and then try to just hold the whole cycle and try to just exit when the cycle becomes better. And then we like to do also what we call growth value, which is basically buying companies at a very decent valuation and try to see if there's an organic growth and a compounding on its own assets across the time. And probably the company I'm going to be introducing today, by the way, we first introduced this company 10 years ago, 2016. Then we made an update in 2019. So as it is now 7 years since our last presentation, we're going to basically update the same company again. The reason for that, I will try to explain as the main purpose of this presentation, is just to insist and try to make clear that the basic reasoning, the fundamental reasoning for being invested in this company is still valid today. So the name of the company is Qualitas. Qualitas is a Mexican company. It's a family-owned leader in the market. They basically do auto insurance. They holding actually some 30-something% market share. It's a well-based company across the country. They work very much like a franchisee model, with headquarters giving services to different franchises around the country, with interests very much aligned between the company and the franchisees. With a very, very, very deep focus on cost efficiencies and services. You will see afterwards that the rest of the competition in general sense, they struggle to make profits, underwriting profits in the country. So that's something we'll try to explain afterwards, the reasons for that. So good family owning the business, very professionalized management team, independent from the family, and an extremely good compounder. So this is the total return since we last spoke about the company. That was in 2019. The share price was just trading at 46 pesos at that time. You have the stream of dividends, and you have today's share price. So the internal rate of return of this investment has been just amazing. To be honest, we did not expect it to be as good as it's been. The reason for that is the market behaved even better than what we thought. Even in hard currency, which is basically translated everything into euros, the return for us as European investors, it's been pretty much the same, because the exchange between the peso and the euro has been pretty stable. We also talk about later in the future possible outcome of that exchange. And the reason for that outstanding performance has been very much based on the quality of the compounding of the book value, revenues per share also compounded 14%, earnings per share compounded 18%, return on equity in average, it's been, if we take the median instead of the average, it's around the 20s. The underlying real return on equity is higher because they actually have, and they've been holding an excess of capital above technical reserves that obviously erodes a little bit the apparent return on equity. This is basically the breakdown of the regulatory capital, and you see the gray bar. It's been growing across the years. The gray bar is the excess of solvency margin, and you see as of the end of 2025, we reach a point of around 15 billion pesos, which roughly speaking is more than 20% of actual market cap of excess of capital that we consider to be excess of cash and net cash position. So should we strip out some portion of that excess of capital, the underlying return on equity, it's more in the area of the high 20s. Okay, so just to give you an idea of how profitable this business is. Dividend per share, of course, has been growing in a very, very, very significant way. And so just to give you a few comments on buybacks. They used to buy back a lot of shares when the share was trading really, really cheap. So they bought back a portion of the company, I think some 13%. Today they have a plan to buy back more shares, but they basically holding, because the stock really got a little bit expensive during the last year, and I think they stopped. They actively buying back shares, but they have a very clear mind in the sense of creating value through those buybacks, as long as the stock is, of course, attractive. And when they realize the stock is not that attractive, they stop for a while. So as I was mentioning before, I think today, even after this fantastic evolution of the stock, I still believe the investment case is pretty much valid today. And the reason for that is Mexico as a market for insurance is still under-penetrated, very much under-penetrated. And I would say the dynamics of the market are pretty much the same as they were 10 years ago. So Mexico population is close to 130 million people with a total vehicle fleet of around 63 million vehicles. So as of today, as you can see, only 30% of the cars are insured. So if we compare to any other OECD country, this low penetration is very significant. No? So, and a very important thing, a good portion of all the policies that are written every year are very much connected to the fact that new cars are financed, and whenever you finance a new car, you're forced to take a multi-annual policy on that car. Okay. So as long as the financing penetration, it's been making a good growth. The insurance comes together with that dynamic. No, so you see that we used to have a steady finance penetration growing across the years. That was from 2007 up to 2018. We reached a level of 60%, and then we continue all those years around 60%. No? So and this is a good catalyst for new policies. Aging fleet, we still have a very old fleet that's been renewed across the years, and the more we increase the GDP per capita, the more renovation we have in the vehicle fleet across the country. It's still we have some 16 years old average fleet, which should be in some sense renovated. No? Motorization rate, which basically measures the amount of cars per every 1,000 inhabitants. I mean, you see we are well below the lowest level of the OECD countries like Croatia, Romania, Slovakia. So still in this regard, we see Mexico quite an emerging market. No? Same graph. No, cars per 1,000 inhabitants compared to GDP per capita, and we see more or less where we sit there in the left corner. So I think the structural dynamics of the country improving in terms of GDP per capita, and therefore we should expect some sort of higher penetration across the coming years. This is same reasoning. As long as GDP increases, the light vehicle units that you tend to sell are higher. We're selling around 1.5 million cars, new cars per year. These are still the same dynamics. There's also a trade-up in Mexico. There are more and more SUVs versus light cars. That increases the average price of the cars that has to be insured, and that increases also the price of the policy. And it's been quite an important dynamic also in the market. So we see how the average new vehicle price it's been growing, and therefore the average policy price has been growing across. The company, they hold today some 35% market share. So it's more than the rest of the top 4 competitors, including GNP, CHAP, AXA, and BBA. So leader by far. And they've been holding this market share for many years. They've been holding that differential market share for many years. And the reason for that is because they are the most efficient company in the country. And that makes them, they have a competitive advantage in all regards, in terms of scale, in terms of pricing, in terms of profitability. They have a very strict rule of pricing. And you will see afterwards the underwriting profit gives a good idea of how good they are in terms of pricing and competing in that regard. So more insight on the market share. Number 1 in light vehicles, number 1 in trucks, number 2 in tourists, and number 2 in scooters as well. As more industry industry comparison. You see on the left side that the next 3 competitors, they don't make money in the sense of the underwriting result. And it's not only in 25, in 24, they only make money on the float, basically. No, so that is a very important thing, because in terms of pricing discipline in the country, all the inflation is it's translated easily into pricing, because the rest of the competition cannot stand not to pass through all this inflation immediately into the pricing. So I'm just going to valuation, dividends, and total expected return that we have in mind from now until 2028. So the valuation approach is very simple. We have an insurance business. Historical combined ratio is 93%. That basically gives us 7%, let's say, operating margin on the underwriting business. And the written premiums earnings normally, revenues are 2.5 times shareholders' equity. So if you get 7% margin, you multiply 2.5 times that 7% margin, and you end up with some 17-something return on equity pre-tax on the insurance business. And then you have the float. The float is also, I think it's 2 times more or less the equity, the size of the equity, and we get some 8% return on the float. So we multiply that 2 times, we get 16% return on equity on the float. We add both returns on equity pre-tax. We have some 33% pre-tax return on equity. We strip out the tax, 30%, and we end up with a return on equity after taxes around 23, 24%. No. So this is the underlying return on equity of the company. It's been behaving like this for many years. So today's valuation, based on our numbers for 2026 and taking into account what I mentioned before, the float results and the underwriting results, we end up with expected net profit, which is free cash flow at the end of the day in this company, of around 7 billion. The company trades today as 165 pesos. It's a market cap of some 65 billion. So we're trading a free cash flow yield to equity of around 10%. Should we strip out, and in order to make an EV calculation for the company, we like to do this as well, no? If we were to just strip out the excess of capital that the company holds today, for us is net cash position, the EV adjusted will be more in the area of 50 billion. And so if we divide that net profit free cash flow into that EV adjusted, our, let's say, free cash flow to EV will be more in the 15s rather than in the 10s, no? Trading a P of 9 times and a price to book of 2 times, no? So a very decent valuation as a start point. So what sort of assumptions should we do for coming years? So you see the amount of pure volume, no new cars. We're moving in a market from insured vehicles, no, of 14 million. We jumped to close to 19 million in 2025. Out of these, Qualitas have some 30%. So last year we have a total policies of 6 million policies. Normally volume grows at 5%, mid-single digit, let's put it that way, okay? That's kind of a normal situation. Pricing, more or less same amount, no? 5%, which is basically translate inflation into the price. So that's a little bit of the recent history of the company in terms of price and volume. The consequence of price and volume growing at 5 plus 5 is that you end up having written premiums growing by some 12% in the case of Qualitas over the last years. And just a few words. I mean, over the last almost 10 years, out of the total earned premium of Qualitas, volume has represented 50%, and pricing has represented 42, inflation, sorry, represented 42%, and real price increase has been only 6%. So in real terms, we all increase a slight figure like 5% in terms of prices, and the rest belongs to volumes. So there's still a lot of growth to capture. Last year we had an issue, and that's the reason why we did not invest before. First, because we don't reinvest before. We've been invested the last 11 years, but we reduce our stake significantly across 24 and partially in 25, because valuation reached a point where we didn't see a lot of value. And then all these things about the VAT, basically the fiscal authority in Mexico changed a law saying basically the VAT was not was not recoverable for the companies. So basically VAT became a cost during last year. And that had an impact in the case of Qualitas of around 2 billion. Obviously, that new cost in the company is going to be translated into prices as we speak, as the company is renovating all these policies. But there was some sort of uncertainty in the sense of how we were going to end up all the situation. And finally, all this new federal revenue law impact is done, is one of the reasons why I think the company did not perform very well across last year. And that of course impacted the loss ratio, but the whole history is now over. So in terms of growth assumptions, despite volumes having grown at an average above 8% over the last 10 years, we're forecasting very conservative growth from now until 2028, roughly speaking, slightly above 1%. Pricing, yes, we assume pricing is going to be growing like 6% annualized, among other reasons because of the new law that I just mentioned, and because of the competition not being able to support any extra cost, and therefore assuming further underwriting losses. They have to admit new price increases in order just to be able to generate some profits. So as a result, we project earnings in premiums to grow from now to 2018 around 6-7%, annualized. So this is a little bit of our valuation. We take the numbers that we just mentioned, we extrapolate those numbers into 2028, and we end up with a net profit expected for 2028 of some 8 billion. We apply a simple target valuation in book value to spot 2 times book value, future book value, that's book value in 2028. And then we also have a target value of 10 times free cash flow 2028. And we calculate both numbers. We get an average of some 77 billion. We divide it outstanding shares, and we get a target price of 196 pesos. That's part of the valuation, but for us what is important, it's not only the target price, but the stream of dividends as well, because there's a nice stream of dividends expected. In total, we expect some 15 billion dividends, which again will represent some 23% of the actual market cap to be cashed in across 26, 27, and 28. And we assume those dividends in a scenario where, I don't know if you can see it, but the solvency excess is still growing. That means that we have been very prudent in terms of calculating those dividends. My humble view is that they can increase those dividends above the levels we're saying here, because there's no purpose for them to just, increase the excess of solvency capital. Okay. So this is the historical stream of dividends. This is the estimated amount of dividends we're gonna get, and of course we get a total return, or expected total return. If we buy at today's share price of around 165 pesos, we add all those dividends, we expect to get some sort of exit at 196 pesos at some point in 2028. We will be getting an internal rate of return of 14%. Okay. This, of course, is in pesos. We should just mention inflation and possible adjustments between the peso and hard currency, in this case, euros. At this graph, we basically have the cumulative inflation differential between the euro and the peso across the years, and compared to the cumulative devaluation of the Mexican peso. So we end up saying in 2025, the cumulative inflation differential was 36, the cumulative devaluation of the Mexican peso was 23, and therefore we have a possible adjustment in terms of relation between the peso and the Mexican peso and the euro of around 12%. So should we translate that devaluation into, so we put euro numbers here, assuming that devaluation, the expected return with the same numbers will go down to 10%. So we always kind of look for double-digit returns. Now our average return over the last 26 years, 27 years has been double-digit. And for us we need to charge the battery in terms of putting in new investments on board that at least will generate some sort of two-digit returns. So even in a scenario where we will assume a devaluation of the peso, we will get that return. And then we always do this analysis in terms, what if we are wrong in terms of timing, not in terms of valuation or in terms of our numbers, but should we expect to get that 200 pesos roughly target valuation instead of December 28, we go down to December 31, how our internal rate of return could be reduced without being below a double-digit return. In this case, in pesos, not in euros, we can even wait until December 33 and still get some sort of double-digit returns. Okay. So these are a little bit of conclusions on the company. It's a great compounder, super serious management, super serious family, super cost focus and service focused company, and that it's still, we believe, in a structural growing market. And so these are a few conclusions that of course you can read, but it's very much what I wanted to share with you. And I guess we will be sending all these presentations to all of you. I have just put a lot of appendix here on our funds team, and of course all the modeling of the company, so you can dig into the numbers and see all these little numbers if you want to just go through in more detail. So thank you very much, and of course open to questions now.
Thank you.
Hi, Luis. Thank you for your presentation. Three quick ones. One is, given this company seems to have a very large capitalization and long-term view with a family behind that supporting the project. Do you think it makes sense to do an acquisition of a weaker competitor in the market? That's number one. Number two, it's how's the distribution here of the policies? Is mainly third party, or is full insurance? Just for curiosity.
I think I got the first question was related to M&A?
M&A, yeah.
M&A in Mexico?
Yeah.
No way.
No way?
No. Organic growth for them is so easy, so profitable. I don't see them. It's true they're doing some vertical integration. They're buying some specific businesses that they can incorporate just to make all these, loss ratio becoming part of the own business in terms of managing all the claims through own subsidies. Okay, but that's kind of vertical integration. It has nothing to do with top line growth. I don't see them. In fact, I haven't mentioned this is the last slide of the presentation in the appendix, but they have businesses across the Central America and South America. They are starting to grow there. They're doing everything organically. They don't like M&A, and they want to get good grid on their own operation from the very start point. And the second question was, sorry?
Yeah, I just want to know the distribution of policies. If only third party, which is what you see mainly in these countries. I come from Venezuela, so
Yep.
people don't have enough money to buy a full insurance. So just wanted to know if full insurance is the play or is only third party insurance.
I don't quite understand exactly the question, because I mean, you mean
So it's a third party responsibility, what the people is hiding there? Or
yes, third party. Yeah, yes, it basically third party responsibility. That's
got
the
it.
average. I mean, there's no enforcement of the law. Theoretically, you have to get a policy for your car, but if the car has no value, there's no enforcement. The real enforcement comes from financing, and from the fact that people are getting into a new level of GDP per capita, so they buy a new car that has a value that needs to be insured. So that's a natural tendency of the country. So we need more GDP to create more penetration. And that's a little bit of the underlying trend that I see now. All the states that have a higher GDP per capita, the penetration is higher. No, so it's still an emerging market in that regard, in my humble view. Okay.
Super, thank you.
Thank you.
Excellent presentation.
Thank you.
I love the company. What do they do with their float, the portfolio?
It's fixed income.
Fixed
basically.
income? Okay.
They, to be honest, they have bad experience in the past with managing kind of their own decisions on equity investments. They decide at some point I think it was a good decision just to stick their investments. I think they have like some 87% of fixed income, which is basically Mexican treasuries. They are yielding. They have a duration of around 2.5 years, and expected return on that is close to 8%. It's the ones we are expecting, and simplify very much the model. Yeah.
Perfect. Thank you. And then the last one, the opportunity in the auto sector is so large that they don't need to move to another vertical or something.
I personally believe so. I think they look at health insurance, and they're trying to do some sort of little startups there. To be honest, I don't think they have, done a great effort. They're just, testing. Let's put it that way, no?
Yeah, hi. In a previous slide, I think I saw that BBVA was growing faster with lower combined ratio.
Yeah, BBVA has a problem because they don't have, I don't know what BBVA has, they don't disclose the acquisition cost. Because normally acquisition cost within the combined ratio will be if you have a combined ratio of 95%, acquisition cost will vary between 22 and 25%, no? Loss ratio will be in the 70s, high 70s, and you have the operations, and you reach that 95% of combined ratio.
So it's not like for like.
BBVI, as they commercialize everything through their own branches, for some reason they don't disclose acquisition cost. So the combined ratio, it's misstated. Let's put it in that way. It's not real.
Okay.
So they have some apparent excess of return, but you have to assess whether that is a real truth of the acquisition cost for them, which I don't personally know. Okay.
Okay, and the second question is, do they do anything on the technology front to improve underwriting? Do they use any technology to make underwriting better or?
I mean, the underwriting, the way they work, as I mentioned before, is they work very much like a franchisee relation with all the agents across the country. So it's for them the main indicator for this agent remuneration system is the quality of the risk, and therefore a low level of loss ratio. That's a very important indication for them. They are not aiming for growth. Growth comes naturally because of new car penetration and because of pricing, of course, inflation translated into prices. They're very serious about taking good risks and pricing correctly those risks. And all these agents across the country are very much remunerated on those bases.
More, I mean, there are some devices you can put on your car
Yeah.
to forecast the behavior, and apparently that improves. Big companies doing it already. I mean,
They've done that for recovering stolen cars and trucks, so to reduce the claim ratio, and they improve very much the recovery ratio in that regard. I'm not aware whether they're using that sort of trying to measure the frequency of use and how well you drive in order to just adjust the pricing that I guess I mentioned. I'm not pretty aware of that. Okay.
okay, thank you very much.
Thank you.
Hey, thank you, Luis, for your presentation. Just a quick question. What do you see as the main risk that could invalidate maybe the thesis on Qualitas? Thank you.
Well, I think the unknowns, as always, no? I mean, probably if you ask me, one of the risks embedded in this country, as many other countries, is regulation, of course. And we've seen that what happened with the VAT. I mean, my personal experience with this company across the last 12 years, it's been only once that we've seen the government ruling against the whole sector, not only Qualitas, okay? The rest, I haven't seen anything special, different from what you will expect to see in any of the European countries where we are based. That's one thing. The other thing, of course, would be some sort of, a big issue in terms of political instability in Mexico. No, but I mean, we all know what Mexico is. No, we all know. I don't want to get into politics here, but we all know that we have all these drug cartels in different states where you can even, go and. But it's been, working in this same situation for the last 20 years, and beside all those, concerns that you can argue there are concerns, but the company operates, with very, very decent returns. No?
Thank you.
Thank you so much, Luis. I think that's it.
That's it?
Yep.
Thank you so much.